What's going on, everyone? Lawrence from Financial Thing. Of course, here again, Thursday evening stream, or Thursday daytime here, but where you are, I'm sure, Thursday evening or Friday morning. Welcome. Hope you're having a great week. What are we going to talk about today? We have a lot to talk about. We're going to talk about some peer-to-peer lending stuff, and we're going to look at Proplin's VAT, value added tax, for people that are not situated in the UK. VAT loans. I've been sort of digging into those a little bit to see what they're all about, and I do find them quite interesting. So we're going to take a look at those and see if they're worth your time and trouble. And we also are going to look at this gap that a lot of people discuss in peer-to-peer lending, especially with lower risk peer-to-peer lending products, whether this gap between savings account rates, which have been creeping up and then creeping back down a little bit, whether the gap between those savings account rates and the lowest form of risk of peer-to-peer lending is actually worth you looking at to put your money into peer-to-peer lending. As we know, those interest rates in savings accounts have been very, very low for a long time, which made low-risk peer-to-peer lending products look more and more interesting and more viable. But as these interest rates have increased, that discussion of to whether that gap is big enough for the risk of peer-to-peer lending, is it worth it for investors? We're going to talk about that a little bit. And we're going to talk about some economic stuff that I think is important, particularly some of the numbers that came out today, inflation numbers, and also the bond, I would say the bond issue that's going on in the UK right now with the gilt prices falling because of the mayhem that the Prime Minister caused, talking about tax cuts. And what does that mean to you as an investor? It means a lot. I'll tell you why a little bit later. But thank you for joining. Please hit that thumbs up if you can. Subscribe to the channel. And I hope you enjoy the stream. We'll have a quick hi to everybody who wants to be hi'd. You can see the real star of the show. I can never seem to do this right. Back there. There she is. You can barely make her out. She's very well camouflaged, but she's lying like an alligator in the weeds looking for a snack. That's Holly. She's the real star of the show here on the channel. But hi, Colin from the Peak District, Paul New in Stockport. Very cold in Stockport. I think I'm going to be heading that way in December up towards the Manchester area. So if I see you, Paul New, I will wave. Paul Bagworth in Kenilworth. Robert Pates from Hornchurch. No more grease for you, Robert. And Peter Vince, of course, in glorious Leatherhead. Leatherhead is always glorious no matter what the weather is, right? As well as Accrington, of course, home of the Aki chap. Alan Stratford is here in a chilly Worcestershire. J.M. Roberts from Toronto. Make the next hour exciting without any doom or gloom. Dramatics, I can't promise that, J.M. Roberts. We're realists here. We have to talk about things that are going on. Peter Clark in Huntingdonshire. And Alan is here in a dry and sunny Basingstoke. Chimpo Naughty in Cambridge. John Day in Nottingham. Stephen Haling in Nottingham. Pretty cool. Everybody's all different places. Annabelle Naira in Ola de España. Hello from Spain. Aki Chap said, Harley, named after your motorcycle, no doubt. Absolutely, that was. When we got Harley, we were trying to figure out a cool name for her, but that was the one that kind of popped out after a while. And Robert says he's full-time in Greece now, sold up. Why was that? I'm just curious. Stevie is here. Don't know, where are you watching from, Stevie, wherever it is. Thanks for joining. Good evening to you. Sure, you're in the UK. So, one thing I do want to say is this is not financial advice. Any of the stuff that we talk about here, I am not an expert. I'm just I would call myself a better than novice investor. I try to pay attention to things. I'm not an expert. Please don't do what I do. Again, do your own research, do your own due diligence. This is purely informational, purely, hopefully, edutainment. I like that, edutainment. And yeah, so please do your own research. I don't want anybody to get burned because of the information that I give. I'm purely providing information and my personal opinion about things that I look at in the news and on the financial markets. And I'm going to also show you the Trading 212 account and kind of explain to you again, as I do most weeks, where I am with that account and what my plan is investment-wise going forward in these turbulent times, because things are very volatile at the moment. I'll tell you, today was a perfect example. If you look at the markets of really this crazy amount of volatility that we're seeing almost on any given day where we get a piece of news. But I do think it's important to have a plan, and sometimes that plan can actually be doing nothing, making no decisions when you feel like things are not very clear in what's going on in the market. So I'm going to show you that too. But let's get right into it. I have babbled on long enough. This, I think, is important. Blend Network hires a new managing director amid their rebrand. Specialist property lender Blend has appointed David Alcock as its new managing director and unveiled a rebrand. If you have been to the Blend website recently, you'll notice things have changed. It's looking pretty smooth, pretty swift. Again, I am not an investor in Blend's loans, but I like the company. I like what they're doing. And they are revamping their branding. And I always like to go in and kind of look at when they make a hire like this. This is a big deal. A managing director is no small position. Jan is certainly very experienced. He came on board in June 2022. And if we look at his previous experience, he was the MD, managing director at Hampshire Trust Bank, for 7 years, and also a partner in the receivership team at Allsops, which is his involvement in the insolvency department, focusing on recovery of debt on behalf of banks and administrators, achieved through either appointment as fixed charge receivers by lenders or instruction by administrators, providing asset management strategy. So basically, the guy specialized in debt recovery, which that kind of experience is very, very valuable in a property-backed peer-to-peer lending company. And he's also had experience in the property side. You can see Land and New Homes Director for Sterling Ackroyd Group, having been with Residential Development and Investment Associate for Allsops. So a ton of experience. I think a major good hire for Blend Network. And, I always talk about this because I think it's important that we look at the people that are actually running these companies that we invest in, because we've had a lot of missteps when it comes to that. So really, really good news. I think that's a great hire for Blend. And good for them, I'd say. Good for them. High net worth lending becomes the latest lender to raise rates. We've been seeing some of these peer-to-peer lending companies bump up their investment rates as the Central Bank of England starts to raise its interest rates. HNW lending, which again I do not invest through, don't really know too much about them. They have been pricing loans, not every single loan, but some of them. This one that they write about here has been priced at 8%. Target rate of return, so a 2% bump on what they normally would have priced this loan at 6%. What they say here is they are now able to justify charging more to borrowers and pay lenders higher interest rates. So good news to you if you are an investor in HNW lending loans. You're going to get some interest rate rises on those loans. £7 million invested in assets capital since September's rate rise. So we've had £7 million since they raised the rates in September. Now assets capital's 3 access accounts have grown from investment amounts from 126 million to 133 million. So a substantial amount of money still being put into those and assets capital access accounts. You've got the instant, or I put quotes around that because as long as there's availability, it can be instant. You've got 30-day, 90-day access accounts. The 30-day access account has more than 45.3 million invested at the time of writing, and that obviously is a 30-day access to cash in normal market conditions. So as long as liquidity is there, and as long as assets can find somebody to buy you out, they will cash you out with a 30-day notice in that particular account. And they have recently eliminated the queue for investors to enter and to invest in those 3 access accounts. So I think, in this investment environment, people are really scratching their heads going, where do I put money? They're trying to look for places to put money in. Assets is obviously being the beneficiary of that money that's looking for homes to go to. Let's see what else. Oh, and also just a little kind of administrative note. Assets has updated its deposit process, and it's more of an intentional deposit process. What this means to you is if you want to deposit money straight into a specific account, you are now going to be able to do that, and they are going to provide reference codes for each specific account within assets capital, so you can send your money directly, say, to the 30-day access or the 90-day access with the correct reference number. If you do not put the correct reference number, your money is probably going to get bounced around. So when you log in to your dashboard and you put deposit, it's going to say, here is the reference number that you use in your bank account to make sure that your money gets directed to the correct account. So I think that's a cool feature. It also said the platform added that is only able to hold funds for up to 9 days before they'll be returned. So you want to make sure, again, that you do put the correct reference number in when you're sending your money, if you are sending money to Assets Capital, so Assets knows where your money is going to go. Now, mention too about this risk to reward ratio. So you can see one of the accounts here that we're mentioning is Assets Capital's quick access account, which is now running at 3.9%. And again, people wondering, well, is this really worth it? Am I worth getting 3.9% within a peer-to-peer lending product when I can get money in the bank savings? Now, I've noticed recently that, for instance, if you go to Ford Bank Savings, you're getting paid on a flexible savers amount, 1.9% variable per year. Fixed saver, you can get better rates, but you got to lock your money up for different periods of time. And then you can do, flexible cash ISA, 1.65%. Now, it's important to know this part here, variable, is really important because these interest rates have actually fallen from where they were just 2 or 3 weeks ago, when I was seeing ads coming in over 2%, 2.2%, now back to 1.95%. So sometimes these flexible savings accounts can draw you in and with these more interesting interest rates, but a lot of people don't realize that they're variable and they do move. So that gap in between peer-to-peer, say at 3.9 or 4%, and a flexible saver at, say, 1.95%, let's call it 2, you're still talking about a double the amount of difference that you're getting in peer-to-peer. The question really comes down to how much you're willing to risk to get double the amount of interest rate, because honestly 2% in a savings account is not really getting you anywhere. If we base on inflation numbers of 8, 9, 10, personally I think those inflation numbers are highly understated. The government is telling you it's 8%. I think it's way more than that. So obviously if you're putting cash in at 2%, you're losing out big time. Even if you go to Money Supermarket, look at the rates. The best rate on Money Supermarket is 2.1%. And Nationwide, again, 2.02%. And Money, Virgin Money. So really not that great. Is it safe? Yes, absolutely. But when you consider that your money is getting eaten away, becoming worth less every day, then is it really safe? I would surmise maybe not. But this rate, again, can change depending on what the Bank of England is doing with their interest rates. So that becomes the question, is how much risk are you willing to take to get returns in peer-to-peer lending? I think the really only answer for me personally is you really have to do both. I think it's very risky to take all of your funds and invest it into one thing, like whether it's peer-to-peer lending, whether it's putting all your cash into the bank. There is risk in that, and I'm going to show you why there is a risk in that. There is a risk in whatever you choose to do. There is risk in it. So I think the only real answer is diversification. Have some money in savings, liquid cash in case you need it, some money in peer-to-peer lending, some money in the stocks, possibly property if you can afford it, and if you're into cryptocurrency, and also maybe some gold. I think hard assets are also going to perform quite well over the next 12 months. We'll see. There's absolutely no crystal ball. I'm convinced totally, too, if we look at the stock market today, we look at the FTSE 100. This is why I'm convinced that nobody knows anything about these financial markets or what is going to happen in the next, fill in the amount of months or years that you want. People don't know. But we saw the FTSE doing pretty well today, having a bit of a bump. And then when those U.S. inflation numbers dropped here, we see this big fallout in the FTSE. And then, for no apparent reason, these markets go back up again. So it's complete mayhem, complete volatility. Nobody can really explain why things are happening the way they are, because I don't think anybody really knows. The S&P 500 over the last 5 days been slowly declining. We see today the inflation numbers come out in the U.S. over 8%. So obviously these interest rate hikes are having a very slow effect on the inflation, and then the markets decide to rebound for, I couldn't see a good reason why. I mean, those inflation numbers were absolutely horrible. So that comes back to the point about make sure that you're diversified. We're not smarter than anybody else out there. When you buy a stock or a share, there is always a buyer and seller, so you're pitting your wits against that other person on the other side of the transaction. So be very, very careful about that. Let's go back to Proplin. We're going to talk about these VAT loans. They sent out an update. I don't know if you can see that. I don't think I can zoom in, but it's talking about their. Oh, here we go. Oh God, that's so big. Hang on. Let's see if I can do that again. No, that's not going to work. It says we're starting to see an increase in the number of VAT, value-added tax loans inquiries being received, and they've made a decision to include VAT loan investments with an always-on opt-in basis. So this is for people that are auto lending. These VAT loans are basically when businesses go to purchase a property that is a VAT registered piece of property. These people who are making the acquisition have to come up with 20% VAT on top of whatever money they're having to put down payment on a loan. So if you can imagine they're buying £1 million property, they got to come up with $200,000 in cash to give to the tax man to cover that VAT temporarily, which they can then get back from HMRC, usually 1 to 2 months later. So what Proplin is doing is providing that loan for the VAT to the buyer of the property and then selling that loan on the market to peer-to-peer lending investors. So pretty cool concept, but there are some things that you need to know. They are priced at 9% per annum gross, which is quite healthy. They are short-term loans lasting for a term of between 45 to 90 days. And the term of the VAT loan is determined by how quickly our nominated VAT agent can recover the VAT payment from HMRC. So are these good for you to invest in? Well, it kind of depends on, I think if you're doing auto lending and you don't have to worry about picking up these loans manually, which is kind of a pain because they're only, maybe 45 to 90 days and you're getting 9%, which is about 0.75% a month. So if you're investing $2,000, you're going to get over 2 months, give or take about £30 of interest. So not bad, but being short term creates a little bit of hassle. And if you're trying to buy them manually, having to pick them up every 45 to 90 days for £30 on 2,000, questionable to whether that's worth it. Auto lend, I would say so. Couple of things you need to about these loans though. VAT loans do not take first legal charge over the underlying property. So a lot of the Proplin loans are obviously secured by a first legal charge on property, but VAT loans are not. Lenders are not relying on the property being refinanced or sold in any order to repay the loan. The loan is repaid when HMRC rebates the VAT amount paid back to the borrower and to Proplin's nominated VAT agent. Lenders will rely on loan contracts, a personal guarantee from the director and shareholders of the borrower for 100% of the loan amount, and the HMRC process of VAT charging VAT payments and VAT returns. VAT loans are shorter in turn, up to 90 days. VAT loans will only have an additional 1 month's interest reserve, and VAT loans are not tranched. And I think one of the risky things about this is obviously the first point here: VAT loans do not take legal first charge over the underlying property. And then also down here in point number 4, lenders will rely on loan contracts, a personal guarantee from the director and shareholders of the borrower for 100% of the loan amount. So you know how I feel about personal guarantees. I don't think they're any better than a piece of bog roll personally, but if everything is done correctly on these VAT loans and HMRC plays the correct game with repayment, I think they're an interesting proposition. Just make sure you understand when you're getting a 9% interest return, there is risk involved in that. So there is no free lunch in peer-to-peer lending or in any of these loans. Some things seem like a sure shot. Even things like Loanpad, which are very considered to be lower risk, there is always risk involved, and that makes no difference with this Proplin VAT loan. But I think it's an interesting solution to a problem that property developers or purchasers find, because let's say they have to come up with a loan down payment of 10% to finance something, and they have to come up with another 20% to pay the VAT. That's 30%. That can be a substantial amount of spondulix. All right, we've got UK inflation CPI numbers coming out October the 18th. This is going to be a very important date, I think, here for the UK economy, to see what happens with the stock market. I think these inflation numbers are going to be high. I don't think this inflation issue is going anywhere, but at 7 a.m. on the 18th of October, which is also my sister's birthday, happy birthday, sis, you're going to find out what those numbers are. Now, this is important because I've said we've seen this volatility in the stock market. A lot of people have been emailing saying, hey, where do I put money? What stock should I buy? And to be honest, at the moment, what I'm personally doing, because there is so much volatility, if you're a trader, there's volatility can be good for you. If you're not a trader and you're a long-term investor, this volatility can be bad because you're watching your accounts go up and down every day. We've been seeing it for a while now. If we look back at the 3-month S&P 500 chart, where we saw this kind of high point of 43.11 and we backed off. So this is since August 22, we've really seen this slow and steady decline. So if you're a long-term investor, you can see that some of these volatile days here, volatile 3 or 4 days going from 3,900 to 4,100, and we've seen 1.5%, 2%, 3%, 4%, 3.5% raises and drops in one day. That's pretty disheartening if you're an investor. So one thing I think isn't a bad thing to do, and something that I've been doing personally, again, not financial advice, is sitting in cash until we can get a real indication of what is going to happen with inflation and what's going to happen with the interest rates. Are they going to settle down? You can see on the trading 212, I'm still sitting about 19,000. I've only got 4,400 pounds invested out of the 19 at the moment with this cash sitting on the sidelines looking for an opportunity to redeploy. And I think that opportunity may come within the next month. But we'll see. We'll see. The inflation numbers in the US were not a good sign. I was thinking and hoping that these inflation numbers were going to be a lot better than what they came out. And they came 8.2%. You see, inflation in the US accelerated in September with the cost of housing and other items intensifying pressure on the US. Households wiping out pay gains. CPI rose 8.2% year over year from last September, which is just a really crazy amount. And again, I think these numbers are very understated. I think these numbers are way more than 8.2, definitely double digits. We've also seen in the US, and I think the UK will be following along with this pattern, US mortgage rates surged to 6.92%, highest since 2002. I think this is going to put a real damper on the housing market, which is going to put a damper possibly. Well, there's two arguments to this. One could say, well, if people are not buying houses, maybe their money goes into the stock markets, inflating those equity prices. But there's also the other case is that people just sit in cash and wait for interest rates to kind of dial back so they can buy property. And I think the same thing will happen in the UK. One of the issues that is very concerning to me is banking. We can see these interest rates. This is Marcus Banking, Marcus account in the UK only paying 1.8%. But something that I read on the Federal Reserve website, sorry, I didn't show you the Marcus screenshot, but here you go. 1.8% gross variable, actually 1.79% gross variable for quick access. It's not great. This is something that I read on the Federal Reserve's website. It's very, very small, but it's a very important thing to know about. And I do get concerned about, economically how banks are doing. They got bailed out in 2007, 2008, 2009. And I wonder if that's going to happen again. There's this little statement down at the bottom. It says, for many, many years, reserve requirements, this is bank reserve requirements, that is, aka how much cash that you need to have on reserve inside of the bank, not physical cash, but on their books. It says, for many years, reserve requirements played a central role in the implementation of monetary policy by creating a stable demand for reserves. In January 2019, the FOMC announced its intention to implement monetary policy in an ample reserves regime. Reserve requirements do not play a significant role in this operating framework. Now, listen to this. In the light of the shift to an ample reserves regime, the board has reduced reserve, this is the Fed, requirement ratios to 0% effective on March the 26th. And that was 2020. This action eliminates reserve requirements for thousands of depository institutions, will help to support lending to households and businesses. The Federal Reserve does this because they want banks to lend out this money. Problem is, stress testing these banks means they don't have to have any money in reserve. So if you deposit $1,000 into your bank account, they can lend that $1,000 out and hold zero in reserve. If there's a run on the banks for some reasons, maybe there's a huge economic meltdown, maybe Mr. P fires a nuke, who knows what could set that off. But these US banks don't have to have any money in reserve, which worst case scenario could result in some real economic problems, some banking issues, lack of liquidity. That's very, very concerning to me, given what is going on in the US and definitely Europe too. Fractional reserve banking is pretty much is a big scam. Fractional reserve banking is a system where only a fraction of bank deposits are backed by actual cash on hand and available for withdrawal. This is done to theoretically expand the economy by freeing capital for lending. Today, most economies' financial systems use fractional reserve banking. And this is, again, one of the reasons why banks had to get bailed out, because they didn't have enough liquidity back in 2007 and 8. So I just wanted to mention that because it's something that has kind of been on my radar for a while, looking at the economic situation and what's going on. We saw this problem over the last 3 weeks in the UK. We've had a guilt problem. Not as in being guilty, even though the government is guilty of what we don't know. But what are gilts? They're government bonds in the UK and other Commonwealth countries. Gilts are the equivalent of US Treasuries. The term gilt is used informally to describe a bond that has a very low risk of default and correspondingly low rates of returns. And basically, they are government bonds. They're supposedly designed to be low risk, safer. But in England, we've had a problem with gilt prices absolutely tanking because of what happened with this announcement of possible tax cuts. People got scared. Bond prices really started to slump. And the Bank of England had to step in, of course, again, the bailout kings, and buy up a bunch of gilts to stop the gilt market from collapsing. Now, why do you care about this? That's what you're probably asking yourself. Here's why. That's why I want to tell you about this. A lot of UK pension funds have been using gilts and derivatives, so they've been taking on excessive risk, gearing up with derivatives inside of pension accounts. And what happens was when the gilt prices started to fall, they've been leveraging using their gilt as collateral to try to make more money in these pension funds. And when the gilt prices have gone down, they get these thing called margin calls, which means the pension has to sell some of their assets in order to pay for those margin calls. It's called liability-driven investment, LDI. We've had many problems in this area recently, and the reason why I'm talking about this is because there's a lot of companies out there that you probably have pensions with, or maybe you know people that do, asset managers. Like, I read I think about Boots. Boots was one of the companies that had been using these leveraging in their pension funds and were getting margin calls, putting really the pension of people that have worked at Boots and are due to get pensions really at risk. So this is why I've always said, and in this article here, you can see right here, it says, we've announced that we'll be out of buying bonds by the end of the week. We think the rebalancing must be done. My message from Mr. Bailey of our wonderful government has said, my message to the funds who are doing this over leveraging and using gilts as collateral, all firms involved in managing these funds, you've got 3 days left now. You've got to get this done. They want to fall. They want to fix this. Pension funds have scrambled to cash raise since Finance Minister Kwasi Kwarteng sparked a bond rout on September 23rd when he announced the government's plans for £45 billion of unfunded tax cuts. These pension funds, were forced to stump up emergency collateral in LDIs, liability-driven investments, which used derivatives to hedge against shortfalls in pension pots after the gilts dropped severely in value. Many of these funds had to raise cash by selling gilts, sparking a vicious cycle of fallout prices. The Bank of England had to step in and save these bond prices. So you need to know that these companies that you're investing in, if you use funds like managed funds, pension funds, they are taking monumental amounts of risk in some cases with your money. And this is why I've always said that DIY investing, do it yourself. Even if you're just putting your money in a tracker fund and leaving it, you don't have to worry about some idiot who's getting paid hundreds of £1,000s or millions of pounds and dollars a year playing with your money and possibly setting it on fire. You would think that these so-called professional investors had more brains than that, but using leverage and gross exposure inside of these funds is very, very risky. So don't trust that the fund manager knows what he's doing. And I think Proplin says this very well in their update. Brian Bartleby wrote about this in his Proplin update that was sent out recently. It says, once again, these not-so-financial wizards had their fingers burnt investing in something they clearly didn't understand, which are LDIs. They don't sound like low risk, which is liability-driven investment strategies. Pensions are supposed to be low risk, and a collapse of the LDIs would have threatened the pension schemes of tens of millions of people. LDI investments are big. They amount to over £1.5 trillion. That's 2/3 of the UK's GDP. LDIs are a way of enabling pension funds to leverage their existing gilt investments and use that as collateral to purchase even more gilts. All sounds good and well in a stable interest rate environment, but if the interest rates rise sharply, the value of gilts fall, and in order to pay the difference or the margin calls on these investments, pension funds had to sell the assets which offered most liquidity, and that was the gilts. So the further the price of gilts fell, the more they had to sell, pushing the price even lower, which is why the Bank of England had to step in. The issue with financial derivatives is when you win, you can win big, but somehow when you lose even bigger. That's why the Bank of England was forced to step in and agree to purchase £65 billion of gilts. By the way, that's your money, taxpayers' money they're using to do that. So be aware, pay attention if you're out there. I know most of you are pretty smart and astute. Some of you do DIY invest, but be aware that if you have your money invested with managed funds or pension funds, they could be playing around with your money in leveraged positions, and pensions do go out of business. They go bankrupt because the fund manager made a mistake, henceforth betting on something like these LDIs. So DIY if you can. DIY, don't let somebody else set fire to your money. It's very, very, very dangerous. Quick look at the Trading 212 account again. Let's see what we're doing. What the plan of action is here. Sitting in cash, approaching 19,100, trying to really just preserve capital at the moment with these way the markets are going, quite difficult conditions. Yes, there are ways to make money out there using things like option strategies. Personally, I'm not that experienced in trying to be a little bit more conservative during these volatile times, but goal is to deploy this money and in hopes to be able to give more away to charity of money made on this fund. But we're sticking right now with 1,400 in Arch, Nova 688, Flex natural gas 1447, and then Vermilion Energy 826 pounds. Actually having quite a good day today, up 4.25% in Synovus. Arch I think is up about 1.5. Flex 3%, Vermilion 5%. So not as good as we were up here, which would have been the selling point, but not as bad as we were down here, which is a $10 swing. It's quite big. But the plan will be to rebuy into most of the assets that were bought in here before, with maybe adding some new ones in. Maybe some of these tech companies have taken a real beating recently. Possibly stock like Disney, maybe some Tesla, if the price is right. But planning on just really sticking with cash at the moment, probably for the next 3 or 4 weeks, just to see what happens with the markets, because they look pretty damn scary at the moment to me. Anyway, hit the thumbs up if you're enjoying the stream. See if you have any interesting comments that will pop up here. Looks like the fan's broken. Aki Chap, the fan is not... Oh, I don't know. The fan's not broken, it's just turned off. He does, Paul. Aki Chap has a very keen eye. He knows what's going on. Stevie is in Stockport. We got Richard Weatherby here in Portsmouth, down by the sea. Nice area, Portsmouth. I like that. Annabelle says the tiny raises in interest rates we're getting compared to what our outgoings are going up by 6.6% mortgages. Why so slow for us to be rewarded by the kind of reflection in our savings? I don't know. The banks, you should ask them why they're slow and why they keep moving them up and down. You have to look for opportunities out there. You could use 1-year fixed deposit, yes. There are some options if you are in the USA, which I think are really great options. I'm going to show you this option. I know most of you obviously are not American investors, but if you do live in the USA, one thing I recommend highly are these things called I-bonds. They are government-backed Treasury Bonds, which are paying for 6 months. You can get 9.62% backed by the U.S. government. I think this bond price will fall probably into the mid-sixes the next time they change the rate. But you can lock this up right now if you are a U.S. resident at 9.6%. So that is a crazy amount of interest that the U.S. government will pay you. You can only do $10,000 US maximum in these I-bonds per person. So if you're married, you could do $20,000, $10,000 each couple. There is a penalty if you withdraw within 5 years of 3 months of interest, but still, those interest rates, they are pretty tasty. And again, that's why we look for those opportunities. Santander now offering 2.9% on a 2.75% on an easy access account. Is there a limit on how much you can deposit? Because I just can't deal with those things. I think it's Peter Vince makes a good point. I think it's worth having a small lump saved in a bank account for guaranteed instant access in case of emergency. Yeah, I always say 3 to 6 months. So depending on what your income level is like, what your assets are like. Some people go 12 months who are super conservative. I think 6 is fine. 6 months of your entire, what am I trying to say? Expenses, living expenses. Everything that you outgo in 1 month, times it by 6. Keep it in cash savings. Yeah, Bank of England has another meeting early December. It's likely to raise rates again. I agree. Aldermore is offering a 1-year bond for 4.35%. Coventry, 1 year at 4.4%. JM Roberts, welcome JM. It's been possible to know minute to minute, hour to hour, day to day the direction of the market. It's not possible to time it. Time in the market is important. It's one of my favorite sayings. My friend jokes about this. He was always saying, remember, time in the market is way more important than timing in the market. Quite the mouthful. Richard McDougall, these one-year bonds with FCFS protection paying higher than lower risk property peer-to-peer like Loanpad. You have to wonder if it's worth the risk to invest in peer-to-peer nowadays. Even crowd property 6.5%. Sorry, even Kuflink and crowd property 6.5% to 7%. I think it is. I think it is worth it if you diversify and you use that as a round ball of investments. Absolutely. That's just my view again. And you've also seen companies like Loanpad moving their percent rates up and up. I think if savings account were to get to 3.5%, 4%, you'd have a hard time justifying investing in peer-to-peer lending at 4% for sure. But they can change. I mean, those rates, just because they're 4% one day, can change to 3% the next day. So same with peer-to-peer. I just don't think bank savings rates are going to stay high. Yeah, just focus on quality loans, quality peer-to-peer lending companies. You should be fine. 250 grand Santander easy access. So what, you can get 2.75. Let's see, Santander. Now I have to look. See what we got on Santander. Everyday saver. 0.2%. That's not good. Must be a different account. What do we got? Savings. Compare savings accounts. Yeah, here you go. Regular e-saver. 2.75 fixed for 12 months. Yeah, but this is the problem here. Save up to £200 a month paid by standing order. So you can only put in £200 a month. Am I wrong? Okay, here's another one. Limited edition. 2.75% for 12 months. Open an account with a minimum of £1. Can have one e-saver limited edition. That's a really, really good savings account. 2.75%. Yeah, these ones that are you can pay in £200 a month max. I just for 2.75%, even 3.5%, I wouldn't bother with it. It's not worth it, man. This one, yes, I agree. That is a good one. Go get yourself those. See what they got on the fixed rate bonds. Here you go. 1.9% to 2.5% gross fixed. Yeah, why would you do that? It's not great. So, all right. Well, listen, let's get out of here. We've been on for 53 minutes. Thanks for joining. We do have guests. I texted Louis from Loanpad today. I think he is coming on in 2 weeks on the 27th, I believe. And still trying to work out the other dates with a couple of other people who have agreed to come on the stream. So it's just a matter of juggling around those dates. But consider becoming a Patreon. Remember, you can snap a camera on that little QR code or look at the link in the description below and support the channel. Hope you enjoy the stream. I will see you next Thursday. Universe willing that I'm alive and well and that the dog lets me do that. And have a great weekend, everybody. Be safe out there. Love you all. Thank you for viewing and commenting. Definitely appreciate you. I will see you next time. Take care. Bye-bye.